Well, Mark Todd is joining us now live from FIIG Securities here in Sydney. Mark, thanks so much for your time. The market now, I guess, definitely looking a little bit more seriously at the prospect of QE3 after those comments overnight from the Chicago Fed's Charles Evans. What are you expecting?
I think the Fed, to some extent, is slightly limited. At the moment, it needs to jawbone the economy up. It's concerned about the level of unemployment, and it's concerned about the, if you like, the jobless recovery that we've been seeing. And so if Europe creates headwinds into that jobless recovery, it puts even greater pressure on the employment numbers. So to some extent, it needs to talk the economy up. It needs to say that the QE3 is around the corner if needed. It can do it in an array of ways. It could extend the terms of the low interest rate environment it now has. Instead of completing that program in 2014, they could go out further to 2015 and just continue to print that money. But at the moment, it needs to give some confidence around how it is prepared to act rather than how it's acting. And the trick for that will be the election cycle. It'll be very hard to act. I think it'll be hard to act in the run-up to an election cycle in November. So at this point in time, it needs to talk the economy up.
I wanted to ask you about a report in Spanish publication El Mundo coming out today saying that the EU's loan to Spain will have a 15-year maturity and a 5-year grace period, so that Spain won't actually have to start paying that back until 2017. What do you make of this, and does this put less pressure on Spain to have to now ask for a formal bailout as was expected?
I think the EU and all the policy makers in Europe at the moment are trying to create any policy that'll ease the pressure. And so it's a circumstance where Spain is saying, I'll avoid my debt for 5 years. I don't know how investor climates will change. They'll say you still have the problem. The problem resides around your property markets and inherently from that into your banking sector. So do you then facilitate funding all the banks, Bank SA, that sort of stuff? Do you facilitate nationalising to some extent those banks and therefore take the hit now, or do you avoid it for another 5 years? Ultimately, they'll have to take the hit. You can only kick the can down so far, but ECB is saying that we need monetary policy, we need fiscal union, we need to get a stronger banking sector. So they'll be looking for some breathing space while they get the politicians to that table. And that's the key to it, getting the politicians and the public, the policy providers to create a reasonable expectation and then act on it.
And Italy's 10-year bond yields rising again overnight. Comments from Austria's finance minister that it may be the next one to have a bailout. Do you think that Italy will be the next domino to fall in the Eurozone? I
think the Italians sound like the Austrians right now, and I think rather than drawing their attention to the fact that Italy will be the next one, it's interesting how that tsunami takes place, because Spain solves itself and we now then put Spain to one side and say, hey, that's fine. We now look for somebody else. That seems to be the case. So they look for the Italians. Upon getting to the Italians, they'll go to the French, and upon getting to the French, they'll go to the English. And it's all around how that integration of that banking sector starts to work. If the banks have been supported in Spain, then they look to who's going to take the haircut as a consequence of that support in Spain, and then they'll go to the Italians, and then they'll move on down the curve. So logic tells me that they'll go for the Italians. It's an illogical time. They're just looking for somebody at the moment. They're bullies.
All right, well, let's look a little bit closer to home. We've had RBA Governor Glenn Stevens speaking this morning about productivity, saying a fundamental shift in household spending patterns is to blame for the patchwork two-speed economy, not the mining boom. What do you think investors will take away from his comments?
I think that they would suggest that it is the mining boom. The mining boom creates this disparity. It means that this multi-speed economy creates an environment where the cash rates are at 3.5%. So if you're on the eastern seaboard with property to sell or working in tourism, you are hamstrung by the mortgage rates and your cost of cash. So the reality is that most of the conversation is driven by the mining sector, and the productivity key that he talks about is really, to my mind, how the workforce adapts to mining. And does that mean, is that a geographic movement? Do they go and support them instead of the fly in, fly out? Are people looking to go to these cities and create new cities, new environments? And that's what the Fed is, our RBA is trying to come to grips with. How do we move the people out of the Wollongong sector, where they lose thousands of jobs, do those people who could have got jobs in mining, do they want to move? And if they didn't want to move, what do I need to do to make them move? And that's where the cash rate resides. It's giving that drive to move them across the Nullarbor.
All right, Mark Todd from FIIG Securities in Sydney, thanks so much for joining us.
Thanks, Liz.